Welcome to the YouTube channel Noman Guru 2. Today topic of our YouTube video is portfolio management checklist, individual portfolio management. What is individual portfolio management? Portfolio management definition, types and strategies by Adam has updated July 29, 2023, reviewed by Thomas Brock, fact checked by Yarilet Paris. Portfolio management, the art and science of selecting and overseeing a group of investments that meet the long-term financial objectives and risk tolerance of a client, a company, or an institution. What is portfolio management? Portfolio management is the art and science of selecting and overseeing a group of investments that meet the long-term financial objectives and risk tolerance of a client, a company, or an institution. Some individuals do their own investment portfolio management that requires a basic understanding of the key elements of portfolio building and maintenance that make for success, including asset allocation, diversification, and rebalancing. Key takeaways: investment portfolio management involves building and overseeing a selection of assets such as stock, bonds, and cash that meet the long term financial goals and risk tolerance of an investor. Active portfolio management requires strategically buying and selling stock and other assets in an effort to build the performance of the broader market. Passive portfolio management seeks to match the returns of the market by making the makeup of an index or indexes. Investor can implement strategies to aggressively pursue profits, conservatively attempt to preserve capital, or a blend of both. Portfolio management requires clear long-term goals, clarify from the IRs or tax legislation changes, understanding of investor risk tolerance, and a willingness of study investment options. Understanding portfolio management, professional licensed portfolio managers work on behalf of clients, while individuals may choose to build and manage their own portfolios. In either case, the portfolio manager's ultimate goal is to maximize the investment expected return within an appropriate level of risk exposure. Portfolio management requires the ability to weigh strengths and weaknesses, opportunities and threats across the full spectrum of investment. The choices involve trade-offs from debt versus equity to domestic versus international and growth versus safety. Portfolio management, passive vs active wise. Active. Portfolio management may be either passive or active. Passive management is a set it and forget it long term strategy. It may involve investing in one or more exchange traded ETF index fund. This is commonly referred to as indexing or index investing. Those who build indexed portfolios may use modern portfolio theory and pretty to help them optimize the mix. Active management involves attempting to beat the performance of an index by actively buying and selling individual stock and other assets. Closed-end funds are generally actively managed. Active managers may use any of a wide range of quantitative or qualitative models to aid in their evaluations of potential investment. Active portfolio management investors who implement an active management approach use funds managers or brokers to buy and sell stocks in an attempt to outperform a specific index such as the Standard & Poor's 500 index or the Russell 1000 index. An actively managed investment fund has an individual portfolio managers, co-managers, or a team of managers actively making investment decisions for the fund. The success of an actively managed fund depends on a combination of in-depth research, market forecasting, and the expertise of the portfolio manager or management team. Portfolio managers engage in active investing pay close attention to market trends, shifts in the economy, changes to the political landscape, and news that affects companies. This data is used to time the purchase or sale of investment in an effort to take advantage of irregularities. Active managers claim that this process will boost the potential for returns higher than those achieved by simply mimicking the holding on a particular index. Trying to beat the market inevitably involves additional market risk. Indexing eliminates this particular risk as there is no possibility of human error in terms of stock selection. Index funds are also traded less frequently, which means that they incur lower expense ratios and are more tax efficient than actively managed funds. Passive portfolio management, also referred to as index fund management, aims to duplicate the return of a particular market index or benchmark.